Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at the Direxion Daily Semiconductor Bull 3X ETF.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so let's just unpack this right away because we have a truly jaw-dropping statistic to start with today.
Yeah, we really do.
Over the last 10 years, this specific fund has delivered an average annual return of like 43.95%.
Right. And I mean, when you compound nearly 44% annually over a decade, you are looking at the kind of exponential wealth generation that, it forces a complete reevaluation of your entire portfolio.
Oh, absolutely.
It is just a staggering level of capital appreciation.
It really is. I mean, it's the kind of number that makes you want to immediately allocate your entire cash position into it.
Oh, sure. Tempting.
But the massive unavoidable caveat here is that this vehicle is incredibly wildly volatile. You don't get 44% average annual returns without enduring some absolutely brutal turbulence along the way.
Yeah, it is the ultimate double-edged sword.
Yeah.
You know, you are exposing your capital to extreme, sudden drawdowns that can, they can shake out even the most disciplined investors.
Right. So our mission today is to break down the underlying mechanics of why this specific leveraged semiconductor fund is the ultimate, high-risk, high-reward tactical play for the AI supercycle.
Exactly.
And we're going to look at exactly how to handle it in your portfolio right now because, honestly, playing with this kind of fire requires a really strict understanding of where the exits are.
Yeah, and what exactly fuels that fire in the first place, right?
Exactly.
That structural understanding is just so critical because when you hit the buy button on this fund, you aren't buying a traditional company.
Right.
There is no CEO, there's no organic revenue generation, and there are no traditional operations going on internally. You are literally just buying a mathematical engine designed to track the daily performance of the ICE Semiconductor Index.
Right. But the catch is it's not tracking it one-to-one.
No, not at all.
It's using complex financial derivatives to provide 300% daily leveraged exposure to that index, which means essentially it's relying on these massive swap agreements with major investment banks.
Yeah, exactly. So the fund enters into these total return swaps. And basically, it pays a financing rate, and the counterparty bank agrees to pay 3 times the daily return of the index.
Wow, okay.
So, like, if the semiconductor sector goes up 2% today, the fund's internal mechanics target a 6% gain.
Makes sense.
But if the sector drops 2%, you absorb a 6% loss. It goes both ways. The actual revenue driving this entire structure, though, comes from the underlying earnings growth of the 30 U.S.-listed semiconductor companies it actually holds.
And right now, I mean, the fundamental outlook for those underlying companies is incredibly robust. We are looking at the absolute heavyweights driving the physical infrastructure of the future.
Oh, yeah. Nvidia, Broadcom, Micron.
Right. The market is treating the AI build-out as an absolute gold mine. And just look at the numbers backing this up. Nvidia's fourth quarter fiscal 2026 revenue hit an astonishing $68.13 billion.
Which is up 73.2% year over year.
Which is insane.
Yeah. I mean, that level of revenue scale combined with that rate of growth is historically unprecedented for hardware manufacturers. It just doesn't happen.
And their data center revenue alone was up 75%.
Yeah.
And that data center spend is the foundational fuel for this fund. When Nvidia sells billions in data center GPUs, it forces an entire ecosystem upgrade.
Right, because you need the whole package.
Exactly. You need faster networking hardware from Broadcom just to connect those GPUs, and you need vastly more high bandwidth memory from Micron to feed them data. It's a whole chain.
Which is reflected directly in the fund's financial health, right? Its wild liquidity metrics. We are looking at an assets under management, or AUM, that fluctuates violently depending on market conditions and capital inflows.
Yeah.
Like, we've seen the AUM swing massively between $8.59 billion and $15.97 billion.
Which is a huge swing. That implies billions of dollars are just constantly sloshing in and out of the fund.
Yeah.
It's not just a reflection of the underlying stock prices going up and down. It's a reflection of aggressive capital reallocation by traders capturing this high conviction momentum.
Exactly. And, despite the management fees associated with maintaining those complex swap agreements every single day, the fund actually even pays a marginal dividend yield.
Wait, really? A dividend?
Yeah, it's roughly 0.52%. It's passed through from the distributions of the underlying securities. So it's small, but it's there.
That's fascinating. You know, I like to think of it this way. Buying Nvidia outright is kind of like waiting in line for hours to ride one incredibly popular roller coaster.
Okay. Oh,
But buying this fund gives you a VIP pass to the entire theme park. Nvidia, Broadcom, Micron, all of it.
I like that analogy.
Ugh.
The caveat being that you were strapping a literal jet engine to those roller coasters.
Right, exactly.
It's synthetic speed, and it's created by those derivatives.
But here's where investors might get hung up. Because since it's just tracking an index, why pay the management fee and take on the derivative risk of this fund instead of just, buying Nvidia outright? I mean, Nvidia is clearly the star of the show driving the returns here.
That's a fair question. It really comes down to isolating and mitigating idiosyncratic risk.
Okay, walk me through that.
So if you put all your allocated capital into just Nvidia, and they suddenly suffer, say, a supply chain bottleneck,
Right.
or maybe a geopolitical export restriction, or even just a simple earnings miss.
Right, something specific to them.
Exactly. Your entire investment takes a direct hit. That single company risk is extremely difficult to manage in a highly speculative tech cycle.
Right, because you're carrying all the structural risks of one specific corporate entity.
Yeah. But by utilizing the Semiconductor Bull ETF, you distribute that risk across a basket of 30 semiconductor companies.
Okay, spreading it out.
Exactly. But because of the 300% leverage, you aren't sacrificing the explosive capital appreciation you would normally seek from a single high-flying stock. You're maximizing your broader beta, basically, to the entire AI supercycle.
So you capture the sector-wide tailwinds while insulating yourself from one single company's operational failure.
Precisely. That built-in diversification combined with that heavy amplification is its competitive moat.
And that 300% leverage acts as a massive amplifier. And you can see exactly how violent that amplification is when you look at the recent price action. I mean, the chart on this fund is staggering.
Oh, it's wild.
Just look at the 52-week range. In a single year, this fund has traded as low as $7.22 and all the way up to $72.36.
Yeah, a literal 10x move from trough to peak within 12 months.
Wow.
It perfectly demonstrates the massive upside potential during a bull run. But, you also have to consider the psychological toll of the drawdowns.
Oh, for sure.
If you bought near the top
Yeah.
and experienced a drop back down to the single digits, I mean, you would need a 1,000% gain just to break even on your initial capital.
That is a brutal reality check. And the recent localized price action is just as intense. Following a brief period of weakness, the fund rallied 11.6% in a single trading session.
Yeah. And that 11.6% single-day pop confirms a very specific market psychology right now.
Mm.
The buy-the-dip mentality is just completely entrenched in this sector.
People are just waiting for it to drop.
Exactly. The moment valuations contract even slightly, institutional and retail buyers are stepping in aggressively to front-run the next leg up.
And looking at the daily chart patterns, the fund appears to be consolidating off those recent highs.
Right.
It is potentially forming a cup and handle continuation pattern.
Right.
If it can reclaim and hold that $70 level, the technical setup suggests a breakout that could run significantly higher.
Yeah, and the momentum metrics and the liquidity profiles certainly support the mechanics of a breakout. The volume alone indicates extreme speculative interest. We're talking an average daily trading volume of over 101 million shares.
Wow, 101 million shares a day, which means you can enter and exit multi-million-dollar positions instantly without suffering from massive slippage.
Exactly.
But, looking at the short interest data right now, it presents a massive paradox.
How so?
The days to cover ratio is ultra low, right? It's sitting at just 0.2 days.
Yeah, and since days to cover basically measures how long it would take for all short sellers to buy back their shares based on average daily volume, a 0.2 ratio means the short sellers aren't deeply entrenched.
Okay.
They could theoretically unwind their entire negative bet in a couple of hours. It drastically reduces the risk of a prolonged bear raid dragging the price down over consecutive weeks.
Okay, but I am going to push back on the bullishness of that, though.
Okay, go ahead.
If the short sellers aren't entrenched, why did the actual short interest volume spike 26.8% in March? I mean, a nearly 27% jump in short volume isn't just retail traders hedging their bets. Doesn't that indicate smart money is heavily betting on an impending crash?
Well, a 26.8% rise in short volume absolutely indicates a large cohort of traders are betting on a near-term pullback. That's true. They are looking at the 10x run from the lows and relying on mean reversion models that suggest the sector must cool off.
Right. That makes sense.
But the influx of new short sellers is precisely what creates the structural trap for a short squeeze.
Oh, because if the price breaks upside resistance instead of pulling back, they get trapped in their own bearish positions.
Exactly. If the underlying semiconductor sector continues its AI-driven ascent and pushes the fund past that $70 resistance level, all those new short sellers who jumped in during March will face immediate margin calls.
Ouch.
Yeah, they will be forced to buy back the stock at market value to cover their losing positions. And that wave of forced, price-insensitive buying acts as rocket fuel.
Launching the fund's price even higher.
Exactly.
So the bearish bets against the fund actually provide the latent kinetic energy to drive the next massive rally.
It's incredibly ironic, yeah.
It's a fascinating structural dynamic. And, it's not just retail traders gambling on these technical squeezes. When you follow the money, the sentiment and institutional flow paint an incredibly bullish picture.
Oh, absolutely. The institutional flow is arguably the strongest foundational pillar of this specific play right now. The fund attracted a massive $1.98 billion in inflows in March alone.
Nearly $2 billion of fresh capital in a single month.
Yeah.
That is aggressive, high-conviction sentiment from serious players who are, looking at the fundamental data, not just hoping for a lottery ticket.
Exactly. We're seeing concrete institutional validation in the recent 13F filings. Major wealth management firms are initiating positions, including conservative institutions like Pin Oak Investment Advisors and Raymond James Financial.
See, this is what surprises a lot of market observers, I think.
Yeah.
Traditional wealth managers typically view 3x leveraged funds as basically radioactive due to the tracking errors and risk profiles.
Oh, for sure.
So why are firms like Raymond James jumping into a 300% leveraged ETF?
Because these institutions understand the underlying math, and they are utilizing the fund strictly for short-term tactical exposure. They are dating the asset, they're not marrying it.
Right.
If a wealth manager wants to capture a near-term semiconductor rebound for their clients, buying this single fund is vastly more efficient than manually buying, rebalancing, and managing the capital gains of 30 individual semiconductor stocks.
That makes a lot of sense.
Yeah, and the fact that multiple advisors are doing this simultaneously signals a broader consensus trade on Wall Street right now.
They're all looking at the same quantitative models. And right now, a tactical strategy utilizing the specific sector momentum has been beating the S&P 500 by 23% since October.
Yeah, and that level of outperformance forces institutions to participate, or they risk lagging their benchmark indexes.
Right. You can't just sit on the sidelines. And the speculative chatter driving those models is heavily focused on what the industry is calling agentic AI inflection points.
Right. And agentic AI is moving past the phase of generative AI, where you just, prompt a chatbot and wait for a response.
Exactly.
Agentic AI refers to autonomous systems that pursue complex goals, execute software code, query databases, and even iterate on their own mistakes without human intervention.
And the hardware implications for agentic AI are just monumental. Generative AI utilizes compute power in bursts, right?
Yeah.
It processes a prompt, generates an answer, and idles.
Yep.
But agentic AI requires continuous looping compute cycles. It pushes GPU utilization rates to their absolute limits 24/7.
And this requires vastly more power-efficient chips and entirely new networking architectures to prevent data center bottlenecks.
Which totally explains why the chatter right now suggests major players have early visibility into sustained growth through 2027 for companies like Broadcom and Nvidia. The hardware demand cycle isn't peaking, it's transitioning from burst compute to continuous compute.
Exactly. And if those agentic AI inflection points materialize faster than expected, this fund is structurally positioned to react with amplified upside.
But
you cannot ignore the lethal risks of holding this vehicle if that momentum stalls.
right. If the institutions are only using this for short-term tactical trades, it highlights the most critical aspect of this strategy, the exit plan.
The exit plan is everything.
Because the primary risk of holding this fund for an extended period is volatility decay.
Yeah, volatility decay is a mechanical trap. Because the fund resets its leverage daily through those swap agreements we talked about, it has actually underperformed the broader, non-leveraged semiconductor sector during certain 5-year periods of sideways market action.
That's crazy to think about. I like to think of volatility decay like driving a hypercar in stop-and-go city traffic. This massive engine capable of extreme speed, but if you constantly accelerate, slam on the brakes, accelerate and slam on the brakes, the internal friction eventually destroys the engine.
That's a perfect analogy. The math behind that friction is just punishing.
So explain the math to me. Let's break it down.
Okay, so assume the underlying semiconductor index is at 100,
Okay, 100.
and it suffers a bad day and drops 10%. So now it's at 90.
Got it.
The 3x leveraged fund drops 30%, right, taking it to 70.
Right, makes sense.
Now, the next day, the market recovers, and the index goes up 11.1%, bringing it from 90 right back up to 100.
So the underlying index is completely flat over the 2 days. It's back where it started.
Exactly. But look at what happens for the leverage fund. It goes up 3 times that 11.1% recovery, which is 33.3%.
Okay.
A 33.3% gain from its new base of 70 only brings it to roughly 93.3.
Wow. So even though the semiconductor index broke even, the 3X fund is down nearly 7%, purely due to the mathematical drag of daily rebalancing.
Exactly. If the market simply chops around sideways, just oscillating up and down day after day, your capital slowly bleeds out without the sector ever technically entering a bear market.
That mechanical risk makes buy and hold strategies incredibly dangerous here.
Highly dangerous.
And that is before even factoring in the threat of macroeconomic shocks.
Yeah, which is a whole other layer. Federal Reserve Chair Jerome Powell recently warned about oil shocks, testing the Fed's ability to manage the economy.
Right.
A sudden spike in oil prices directly translates to a spike in inflation. If inflation reignites, the Fed is forced to keep discount rates high, which severely compresses the valuation multiples of growth stocks.
And high multiple tech stocks are the first assets liquidated in an inflationary panic.
Yep.
And if a macro shock causes the semiconductor index to drop 10%, this fund instantly shaves roughly 30% off your capital. It amplifies the macroeconomic pain just as ruthlessly as it amplifies the AI gains.
Which is why managing that risk requires keeping a very close eye on the catalyst calendar to see which way the momentum will break over the next quarter.
So there are 3 main catalysts upcoming that we need to watch.
Right.
First, we have earnings. Nvidia's Q1 fiscal 2027 guidance is setting a towering $78 billion bar.
Yeah.
If they confirm sustained agentic AI demand and hit or exceed that $78 billion, it provides a massive direct catalyst for the fund.
Absolutely. Second, we must monitor the macro volatility environment. The VIX recently sat near the 95th percentile, which indicates an extremely nervous broader market.
Right.
But if we see geopolitical stabilization, maybe a cooling in oil prices and a subsequent drop in the VIX, that reduction in systemic fear acts as a massive tailwind for high-data tech names.
Makes sense. And the third catalyst is sector rotation. We've seen significant capital hide out in value and energy sectors during recent market jitters. But when the broader market regains its risk appetite and shifts that capital back into growth, this fund stands to benefit disproportionately due to the 3x leverage factor catching the institutional inflows.
Yeah, but given the severe volatility decay and those looming macro risks, the management strategy for this asset has to be rigid. You must treat it strictly as a tactical trading instrument.
So you use tight, disciplined stop losses to protect your capital.
Always.
Specifically, trailing those stop losses below key technical levels, like the 200-day moving average.
Right.
You want to capture the aggressive upside when the trend is clearly established, and you want to be completely out of the position before the sideways chop begins to grind your capital to dust.
That's the game plan.
Yeah.
So, based on the fundamental tailwinds of the AI supercycle and the undeniable institutional inflows, the Semiconductor Bull ETF earns a bullish score of 7 out of 10.
Right. The volatility decay and the sensitivity to macro inflation shocks keep it from scoring higher.
It's not a buy-and-forget asset.
No, it is a strictly high-risk, high-reward vehicle. It is perhaps the most efficient liquid instrument available for capturing the explosive momentum of the AI build-out, but strictly on a tactical swing trade horizon of maybe 1 to 3 months.
Yeah, it requires active management and, honestly, a stomach for severe intraday swings.
Yeah.
But the structural opportunity is just massive.
It really is. Well, we've spent today unpacking the explosive potential of this AI infrastructure gold rush and the mechanics of capturing it. But I want to leave you with a final thought to ponder as you look at your own portfolio right now. If we are truly hitting an agentic AI inflection point where artificial intelligence moves from passively answering questions to autonomously executing complex economic tasks, the physical infrastructure requirements are going to be monumental.
They are.
So are you actually positioned in the companies building the physical picks, shovels, and power systems for this revolution? Or are you just holding consumer software companies and hoping they figure out how to monetize the trend?
It's a great question.
It is the underlying infrastructure that historically captures the real wealth during a technological paradigm shift. Thank you so much for joining the conversation today. Keep doing your research, stay strictly disciplined with those stop losses, and stay sharp in the markets. We'll see you next time.